Great. Thanks, Roshan. And good evening, everyone. Thanks for joining us this evening for our first quarter US tech strategy and stock picks. I guess we'll just begin. The next slide here is just a disclaimer that this webinar is solely just for educational purposes. The outline of our webinar today, we're going to run through what happened during the last quarter of 2022. Go through some macro as well as sector themes that we think or that we've seen and that we think are going to be emerging in the upcoming quarter. Run through the FAANGM stocks as well as some of our other stock coverage, other companies that we've initiated on, before ending with technical analysis and a Q&A. Just a reminder, feel free to post any questions in the Q&A tab, and then we'll get to it at the end. So just to recap, what happened in the fourth quarter of last year. We saw kind of a modest recovery across most asset classes. The S&P 500 was up 7%. The NASDAQ was fairly flat. Bonds recovered slightly. Gold performed the best, and they were up 10%. Mainly, I guess, in part due to significant depreciation of the US dollar. And commodities rebounded slightly as well. Year to date, stocks and bonds fell together for the first time in about 50 years. It was mainly because they were affected by high inflation as well as rising interest rates. So there still really wasn't much safe haven. I guess gold and commodities would have been a good safe haven for this past year. You would outperform the S&P if you just put your money in there. In terms of sector performance, cyclicals actually outperformed in the fourth quarter of 2022. This was partly due to better than expected inflation numbers, some easing in supply chains, as well as China opening up. So you can see here, energy was up 21%, and industrials 19%, and materials up 14%. Consumer discretionary was the biggest laggard, and it was down 9%. It was the only sector that was down. And this obviously was amidst concerns over slowing consumer spend as well as contracting margins from a lot of these discretionary companies. In terms of year-to-date numbers, growth continues to underperform. So you can see the real winner of this year was energy. So I believe it's the third year in a row that it's really outperformed the market. Defensives held up well as well. So utilities, consumer staples, and healthcare, they were, I guess, 2% to 4% down. While you have your growth stocks being severely battered, consumer discretionary as well as your communication stocks. So like stocks like Meta and Netflix. In terms of currencies, surprisingly, the Sing dollar actually performed the best versus the US dollar. So the dollar actually weakened versus most other currencies in the fourth quarter, particularly against the yen, where it was down 10% to the yen. And so this is quite interesting because it actually should be kind of a tailwind for fourth quarter 2022 earnings for a lot of your tech companies or your major companies, because most of their revenue, or at least 50% of their revenue, is generated outside of the US. So for the first 3 quarters of this year, it's been the opposite. The dollar really strengthened, and that provided quite a significant amount of growth headwinds, somewhere in the range of 5 to 10% for a lot of companies. And we should see this kind of, I guess we have seen this kind of a flip on its head for the last quarter of this year, or last year, sorry. Yeah, so surprisingly, I guess if you were in Singapore, you actually put money in US dollar, you would have lost 1%. So we're just looking at the S&P 500 and some of its historical kind of measures. You can see that that suggests that there could be a little bit more downside risk for the S&P 500 when you add up, or rather when you average out the last 3 kind of crashes, the .com, the GFC, and COVID. The average kind of decline was about 45%, 40 to 45%. And the tech wreck that I guess happened, over the last year, from peak to trough, it was basically only down about 25%, and currently we're down about 17%. But we do think that the economy is actually a lot healthier right now than it was back in the .com bust, and definitely a lot stronger than it was during the GFC. So what are some of the macro themes that we're actually seeing, and some of it that we expect moving forward? The first is that we think that recession is a when, not an if. When you look at the yield curve inversion that has historically been quite an accurate indicator of recessions, you can see right here that it's gone down to levels at about minus 70 basis points. So that's the most significant inversion in about 40 years. And I guess a lot of economists as well expect a recession to come sometime this year. No one really knows when it would come exact. Some speculate that we're already in it. But we do definitely think that we'll hit one sometime soon. Sometime probably in the second half of this year, or I guess in the second or third quarter of this year. One of the kind of concerning things is that the personal savings rate in the US has actually fallen below 3%. Its 40-year average is around 6%, and it's continued declining quite significantly over the last couple of years. And this obviously is because inflation has risen. It's caused a lot more to buy a lot of things. It's continued to eat into people's savings. So we do think that a downside would be, or rather this could be a little bit worrisome if high inflation persists and unemployment rises. But speaking about unemployment, unemployment is still at record lows at only 3.7%. Usually once it gets above 5, or rather if it's below 5, it's considered fairly healthy. But surprisingly, there are almost two job openings per unemployed person in the US. So, which is, I guess, probably why this coupled with low unemployment is probably why the US hasn't been declared to be in a recession as of yet. We are seeing a little bit of a mismatch in terms of job openings, though. There are a lot of in some areas of the economy, there are a lot of jobs that just aren't being filled. There aren't enough skilled labor, or rather labor workers, blue-collar workers that want to pick up these jobs. So our second macro theme is we expect the Fed to slow down. And this is quite consistent. They've been fairly consistent over the last couple of meetings, that they are going to start to slow down the pace of their rate hikes. When you look at inflation, the US core PCE, right now it's trending at about 4.7%, so it's down from 5.4% at its peak earlier in 2022. But when you look at the red line over here, which is the federal funds rate, the Fed funds rate was basically zero for the I guess since COVID, March of 2020, and you saw this massive rate hike over the last year from almost 0 to 4.3%. And we do think that and obviously this has closed the gap on inflation numbers, and we do think that usually once the Fed funds rate crosses the rate of inflation, that's usually when you start to see rates being cut slowly. So we do hope that that obviously once inflation starts coming down a little bit more, and once over the next rate hike, the Fed should start to slow down and hopefully, I guess, either pause or cut rates. When you look at this chart, this is just the Fed funds future expectations. It's what the market expects the federal funds rate is going to be. You can see right now we're around 4.1%, 4.2%, and the market expects rate to peak at about 4.9, I guess 4.75 to 5% towards, I guess, the second quarter of this year, before slightly tapering off. But we do think that the Fed funds rate is going to be fairly elevated, at least compared to what we've been having over the last few years. Now I will move on into I guess talking a little bit about inflation. So we think that inflation seems to have peaked, but we do still expect inflation to remain high. So just a chart on some of the key components of PCE. In the green line it's food and energy. And you can see that has kind of come off quite significantly from 22.5% to 14% year on year. At the same time, motor vehicles has come down from 21% to about 4%. But we do think that one of the reasons that we think inflation will be a little bit stickier this year is because of wages and housing, which is essentially the purple line. So it kind of falls under services. You can see that it has been quite steady in terms of its rise, but steady but slow. And one of the reasons why we think that inflation will be sticky is because hourly wages have continued to increase at a rate of 4 to 5% year on year. And so if you think about it, if wages start to continue increasing and unemployment remains low, there's a lot of buying power for consumers, and they're still able to kind of fork out the higher prices for a lot of goods. I guess the good news is that we do see a lot of easing in the supply chain issues, in terms of the supply chain issues. So the Baltic Freight Index is actually down to almost pre-pandemic levels. So we should be able to see some sort of pass through from that into a lot of the prices for goods that we pay now. Yeah, so that's I guess the outlook for inflation. It's obviously peaked in the first half of last year, but we do still think that it'll be sticky for quite some time. So we are also seeing overstocked inventories starting to come off. We saw this in the previous quarterly outlook. There was quite the retail inventory to sales ratio was close to 1.6, which is way above its pre-pandemic levels, and significantly above the lows at about 1.2. And this seems to have come off quite a bit to about 1.45, 1.4. This was basically due to a lot of, I believe, a lot of discounts by retailers clearing out their inventory. But at the same time, when you look at the total inventory, which is the red line, inventory volume, it still remains at all-time highs. So we still do think that this could be a headwind in terms of margin compression for a lot of retailers, because they still do have a lot of inventory that they kind of have to get off their shelves. When it comes to valuations, we do think that we are still seeing a derating in valuations continuing. And we do think this will continue through at least the first quarter of this year. When you look at the NASDAQ forward PE, right now it's hovering around 21, 22 times. And there's this I guess, concern that especially for tech companies, that growth will be quite muted for this year. If you just kind of compare, and then obviously this is because we're kind of entering a recessionary environment. There's a lot of headwinds in terms of FX and contracting margins. When you look at the last bottom, the bottom of the GFC on the left side of this chart, you can see that the NASDAQ forward PE was around 15. So if you think about it, there is still some more downside to go. If the forward PEs actually do drop to about 15, although we do think that this is quite unlikely. We do think that I guess somewhere in the 17 to 18 forward PE, 17, 18 times forward PE would be a bit more realistic if the NASDAQ does drop a little bit more, and that kind of relates to about 10 to 15% more downside. And a big reason for this is not really that the earnings have slowed down. It's just that investors aren't willing to pay the super high valuations that they were willing to pay during the risk-on environment over the last few years, with the Fed kind of having this very loose monetary policies. When you just compare like the NASDAQ's earnings yield, which is essentially it's the inverse of the PE. So you just take 1 divided by the PE. And if you compare it to the US 10-year spread, there's a US 10-year yield that has gone up quite significantly over the last year or so. You can just see that right now the spread is almost zero, and that kind of I guess in investors' mind, when you look at this spread, you look at treasuries that are yielding almost 4%, similar to the NASDAQ, but they're a significantly less risky asset, and we do think that this is one of the reasons why there are still some headwinds in terms of investors being a bit more bullish and being a bit more risk on. They just don't see the risk return reward that maybe they used to see. When we look at some of the FAANGM valuations, FAANGM valuations right now are more than one standard deviation lower than their average, their 10-year average. So right now, I guess the 10-year average is a little bit higher, 31 times. But we do think that growth is still going to be challenged, especially mainly due to the higher interest rate environment. So we are a little bit more selective on the FAANGM as I guess a category of tech stocks, your big tech stocks. We do think that there only really there's really only one way for FAANGM stocks to kind of start on a bull run again, and that will really be for earnings to start turning instead of declining, especially with a tighter Fed monetary policy. And investors really not willing to pay that much for in terms of valuations. This is just a little bit of a different chart when you look at their price to sales for the FAANGMs. Like I mentioned earlier, right now price to sale is about 5-6 times, which is almost the average. But when you kind of look at it during the pandemic, it's about 8 times with 25% growth. Pre-pandemic, it was trading about 6 times with 20% sales growth. So right now, if it's at 5 times and the forecast is really for only about 10% growth, we do think that the PS could drop a little bit just because growth has significantly declined. Similarly to the NASDAQ's yield, the FAANGM yield right now is actually negative when you compare it to the US 10-year earnings yield, or rather yield spread. So essentially, you'll be earning more if you just put your money in the US 10-year than if you were to put money in the FAANGM right now. Yeah. So this definitely, it makes it a little bit less attractive for FAANGM stocks, and probably why you see these depressed valuations. So when it comes to the third question, what kind of trends are we actually looking out for? The first would be retail sales. So this is not just retail sales, but it's actually durable goods sales. So sales of your electronics, your appliances, your furniture, cars, and jewelry. And we see that over the last year, retail sales has actually been kind of going in a downward trend, which is a little bit concerning, especially for consumer consumer electronics. The demand for consumer electronics, the demand for PCs. People have bought a lot over the pandemic, because they're durable goods. They can last you quite a while. You don't really need to buy more of them. And when you look at it compared to 2007, which is a period of also high interest rates, this number was about 222 billion US dollars. When you compare it to the pre-pandemic, it was at $212 billion. Right now, we still think it is very elevated at $233 billion. So we do think that there is some room for this to kind of taper off a little bit, especially as inflation remains high and goods remain a little bit more expensive than what people would like to pay for them. In terms of digital advertising, most of the digital advertising companies really took a hit this year, and a lot of it was obviously a slowdown in consumer demand. Companies are just tightening up their budgets in terms of marketing, because they just weren't selling as much. When you look at digital advertising growth, we saw this massive ramp up in growth from 2019 to 2021. 2021 was like 38% growth for the whole industry globally, which is quite a huge amount. And for this year, we expect this to drop to single digits for the first time in a long time, about 8 to 9%. And for the next few years to kind of taper off at around 10 to 11%. I guess one of the main reasons that we think that this trend is kind of going to continue moving forward is just because of people. I guess companies are going to be a little bit more prudent in terms of their spending, at least for the next couple of years, especially with this recession that everyone is expecting. And people are the story is no longer, we're just going to grow our business, grow at all costs. Companies are definitely already looking to being a little bit more prudent. So there's this fundamental shift in how corporates want to run their business, and we think that digital advertising will be kind of affected quite severely by that. You're not going to be able to see your mid-teens to high teens growth anymore. And I mean, 10% is still pretty good, but for an industry that had very high growth expectations, we do think that this will taper off a lot of valuations, especially for growth companies, for ad companies like Meta and Alphabet. In terms of streaming, which is actually one of the most positive in industries that we see globally right now. Streaming right now is about 38% of total TV usage in the US. And it continues to grow from strength to strength. So from basically, in the whole year of 2022, it grew from 29% market share to 38% market share. We do think that this trend will continue moving forward, especially as it kind of takes share away from other forms of traditional TV like cable and broadcast. And we do also see that a lot of streaming companies are being very aggressive right now. They're acquiring a lot of TV rights, or I guess streaming rights, to a lot of popular events, live events, especially live sporting events in the US, which definitely will take away a lot of viewership time from traditional TV. And obviously, one of the reasons why people love it is because it's a little bit more of a flexible option to streaming up to traditional TV. You can watch it on the go. You can download the shows in your phone. And at the same time, in the US, it's actually a significantly cheaper option for consumers. I guess a little, not too much in Singapore, but overseas, your local cable bill can go up, $50, $60, $70, whereas if you just get a monthly subscription from Netflix, it's like $12, $13. So there's significant cost savings in that area. At the same time, a lot of streaming companies, they are growing their inventory. They're releasing a lot of streaming first movies, streaming first series that you can only kind of watch on these streaming websites. And it's definitely a trend that we think we are quite bullish on. And so obviously these will be tailwinds for streaming players like Netflix, YouTube, Disney Plus, and so on. So with that, the last sector that we're going to look on, I'll hand my time over to Mac to go through the smartphone shipments and a couple of companies from our big tech. Over to you, Max.
Thanks, Jonathan. So I'll talk about the smartphone industry. So the global smartphone shipment is estimated to decline by 8% in 2022, mainly because of the macro events that decrease the demand. But however, this number is expected to recover and grow by 3% in 2023, which is this year. So, however, as always, we expect the recovery not to be uniform, particularly in the emerging markets where budget smartphones are more popular. As the recovery there will be more challenging because the consumers are more heavily impacted by the higher levels of inflation, whereas those in the developed markets have offset some of these inflation pressure because the providers are offering extended financing plans, some more attractive trade offers, as well as they have also increased their promotional activity. So as for the growth momentum that is expected for the next few years. This growth is attributed to the rollout of 5G phones, which is the thing actually right now. And then and consumers as well as the increasing popularity of foldable smartphones. So along with this trend of the 5G rollout, the average selling price is expected to increase as well, mainly because firstly, as I mentioned, the increasing popularity of 5G phones, which cost quite significantly higher right now. And then it's also because consumers are opting for more premium devices, with premium devices defined as those costing 500 USD or above. And consumers are doing this because they want to have devices that can last them for longer periods of time. So yeah, that's my quick update on the smartphone industry. So now moving on to our recommendations for big tech, and I'll start off with Apple. Yeah, so the story for Apple firstly is that same as last quarter, we believe that Apple is going to enjoy the benefits from the higher average selling price from its iPhones, mainly because the more premium models, the iPhone 14 Pro and Pro Max, are continuing to sell much better than the basic 14 and 14 Plus. And furthermore, Apple also took out the iPhone mini series from this year's lineup. So this means that the starting price of iPhones has also increased quite significantly. So this higher ASP is going to benefit Apple because it is going to increase their revenue. So it's going to contribute to revenue growth. And we are actually modeling the iPhone revenue to grow at a CAGR of 6%, a 2-year CAGR of 6%. And this is after using a conservative assumption in terms of the amount of units shipped. Yeah. And then secondly, the second point for Apple is that the supply concerns that face Apple because of the COVID disruptions towards the end of last year has largely subdued, because the main production plant in Zhengzhou is reportedly operating at 90% capacity. So this means that the focus has shifted from the worries that Apple not being able to meet the consumers' demand to Apple's ability to recapture the sales they may have lost during the holiday season. So with this regard, we actually think that Apple is capable of doing so because it enjoys a strong customer brand loyalty, where customers will not just buy a smartphone from another brand, and cancel the plans of buying an iPhone just because they have to wait additional 1 or 2 weeks for the iPhones to become available again. So, however, we would like to note, despite this, we would like to note that the recent spike of COVID cases in China is going to continue. Will continue to pose uncertainties towards Apple's supply chain, mainly because the factories there needs healthy workers to maintain a stable supply level. So, although the Chinese government has lifted its zero COVID policy, if there is an outbreak in the key production plant, employees may be unable to go to work because of the sickness, or others may decide to stay out of work altogether because they want to minimize themselves of getting infected. So overall, we think that with the expectations that smartphone demand will going to recover this year, we think that Apple is going to be able to execute and benefit from its strategy of growing its revenue by increasing the ASP for its products, assuming that they are able to maintain a steady supply level. So overall, we maintain our buy rating on Apple at target price of 190 US. Yeah. Now moving on to Amazon. So for Amazon, firstly, we think that its retail e-commerce business dominance is going to continue, mainly because we don't see any significant change fundamentally in the e-commerce industry. What we mean by this is that there's no significant shift in the competitive landscape, and there's also no significant change in how an e-commerce company conducts its business. So overall, we think that the market share of Amazon of over 30% is not going to decline or go away anytime soon. And the same story goes for AWS as well. There's nothing fundamentally changing in the cloud computing segment. So we think that AWS is going to continue to benefit from the cloud migration trend that is done by companies right now, especially in this current macroeconomic environment where companies across the board are trying to save their costs, because many companies have decided to adopt this technology as by doing so you will save costs in your manpower, And you also reduce the potential of having to incur any capex to upgrade your physical server. So we think that this is a good opportunity for AWS to expand their clientele, because especially when the cloud computing industry is expected to grow significantly quite in the next few years. However, despite those positives, despite those reasons, we think that the short-term macroeconomic environment right now is affecting both the retail and AWS segment. For retail, as we all know, the high inflation is causing consumers to cut back on their discretionary spending, and the trend of high levels of inventory and the compressed margin also continued through the third quarter of last year for Amazon. As for AWS, it's because companies, its clients, are cutting back on their costs, so they are actually opting for lower tier product which cost less. And Amazon has actually said that they are actively engaging with the clients to help them find the most cost-efficient solution that meets your needs. So we think that by doing this, Amazon is sacrificing some of the revenue growth potential for AWS for the short term. But we think that by doing this, they are also building long-term relationship with the clients. So this will translate into recurring revenue in the long run. Overall, we think the long-term thesis for Amazon remains intact, but it's just that it is heavily exposed to the macroeconomic environment that is affecting its customers, which is in full effect right now. So we maintain our neutral rating on Amazon with a target price of $108 US. Yeah, so that's all for me for now. I'll hand over my time back to Jonathan to cover Alphabet.
Thanks, Max. So I'll begin with Alphabet. And the main story for Alphabet is the multiple levers of growth for the company. It is, I mean, I guess, yes, it is a predominantly a digital advertising company, but there are also additional levers that come in from cloud and YouTube. In terms of digital advertising, they still remain the dominant player with about more than 50% market share. The quarter 2022 revenue grew about 11% in constant currency, which is a significant downgrade from 2021 and 2020. I guess every year prior to 2022. But we do think that, and obviously one of the main reasons for this, one was the FX headwind, and two was a significant drop in advertising demand, and three, you're just really having very tough comps versus 2021. That was a very strong year across all 4 quarters. In terms of cloud growth, cloud grew its revenue 38% year-on-year, and remains Google's fastest growing segment. And one of the main reasons for this, they are a little bit different from AWS. The main target audience for Google Cloud is a lot of your startups, a lot of your smaller SME companies. They want to make use of their workplace solutions, and products that generally are a little bit cheaper to kind of acquire and a bit easier to use, but are still able to leverage the power of the cloud for especially for companies that still scale quickly. They don't really have the capacity to spend money on their own significant server rooms, stuff like that. So that's really where Google Cloud kind of shines. At the same time, they are also heavily investing in cybersecurity. So they are also providing a significant cybersecurity protection for their cloud users. Just for some comparison, revenue growth pre-pandemic was about 23% over the 5 years pre-pandemic. In terms of YouTube, YouTube revenue actually doubled from 2019 to 2021. And the way YouTube makes its money is mainly from ads that it shows on its platforms. We do expect 2022 to be flat or slightly up in terms of revenue growth. And two real reasons, two factors for this. One, or rather 3 factors: FX headwinds, slowdown in digital advertising, and the third is the most important factor. They actually kind of shifting or putting a lot of focus on YouTube Shorts, which generally monetize a lot slower than other forms of advertising. So it's kind of like a short-term pain for long-term gain. Like if more people are viewing YouTube Shorts, you're taking viewership away from your normal videos or other ads. The views go up, but the monetization rate goes down, and you earn less money from it. But we do think that over time, these monetization rates will slowly creep up and catch up to just regular short video and digital ads. At the same time, Alphabet is also a monopoly power in many other verticals. So your Android, it's basically the only, I guess, one of the main operating system for mobile phones that are not iPhones. It also has a monopoly over digital maps, so everyone uses Google Maps, and so it has all these kind of levers where it's able to generate enough data for its digital advertising business. And this is one of the reasons why we actually like Alphabet, because it is somewhat insulated, or rather, it's a little bit more diverse when it comes to its business model. It's not strictly just digital advertising that's reliant on other third parties. In terms of valuations, we think that valuations right now remain fairly attractive. So right now it's trading at about 17 times for PE, slightly below its 15-year average of 21 times. And you can see in this chart over on the left side, during the end of the bear market in 08, valuations kind of got compressed to 15 to 17 times range. And that was when and after these valuations, the growth really exploded quite exponentially. So we do think that in the near term, there are valuations look attractive in the long term, but in the near term, there are still some kind of pressures in terms of your revenue growth headwinds, mainly because there is still a slowdown in the digital advertising industry. And like I mentioned earlier, we don't really think that it will pick up that significantly moving forward. So yeah, I mean, but when you look at Alphabet or Google as a company, they did generate, or we expect them to generate free cash flows of about $50 billion US for FY22. And this obviously is quite a significant amount of money. We do expect return on equity to be about 24% for the year as well, slightly down from 32% in FY21. But we do think that a lot of this will recover, at least in the second half of next year, especially as we saw quite a significant margin compression, or rather, we saw margins kind of contract by about 7% last year. That we think will reverse, especially as they reduce a lot of their discretionary spending, and they have already mentioned in their past two quarterly earnings calls that they are planning to look at expenses a little bit more prudently. And this kind of goes across the board for most of big tech companies. So we still maintain a buy rating on Alphabet with a target price of $124 US. So moving into Meta. So the headline for Meta is we think that right now they're kind of trading like a value stock. They're trading at about 10, 11 times forward PE, which is actually significantly lower than a lot of the consumer staple companies, which are trading close to 20, or even exceeding 20 times forward PE. We do think they are an unappreciated company. That's obviously because there has been such a great amount of bad press on them. They laid off a lot of workers, which actually was great for the stock price. But we do also think that with the company's kind of intense focus on building out a metaverse, we are a little bit worried that they are taking their eye off the ball into their main core business right now. But obviously, with the cuts being mentioned over the last quarter, and a little bit of recalibration similar to other tech stocks. We do expect this to kind of turn around a little bit for this year at least. So in terms of free cash flow, we expect Meta to generate about 15 billion in free cash flow for FY22 and about 27 billion for FY23. Currently, they have about 40 billion in cash and marketable securities on their balance sheet, and they have a debt-to-equity ratio of about 0.1. So they really have almost no debt. They have a lot of equity, a lot of cash, and so they are still a very healthy company. Obviously, they are a little bit less insulated compared to Alphabet when it comes to the digital advertising slowdown, mainly because they don't really have any other revenue outlet, a significant revenue outlet. Most of it just comes from ads placed on their platforms, just because they have a lot of users. We do also think that they kind of overexpanded a little bit over the last couple of years with the company growing so much, and especially as they kind of put a lot more emphasis on spending in the metaverse, as well as a significant platform change from your more static, I guess, feed, Facebook feed to short form reels, which monetizes slower than your feed. But we actually do think that the layoffs, which I believe it's about 11,000 layoffs that the company is planning to make, we do think that this will help to alleviate a lot of the costs that they've built up over the last couple of years. And obviously, the cost has seen operating margin drop from 40% in 2021 to about 26%. So it's a 14% drop over 1 year. And we do hope that, and we do expect this to increase quite significantly back into the 30% range, which should help the company's bottom line as well. But we do think this will take a little bit of time. And so we still have an accumulate rating with a target price of $113 US, with the stock closing last at $132.89. Our last company would be Netflix, and the title for this would be Riding the Streaming Wave. So Netflix obviously continues to be the dominant video on demand streaming player. They've seen ARM, which is their average monthly revenue. So essentially, their average subscription prices. We've seen this continuing to climb to around $12 US. At the same time, they've also been able to increase their subscribers threefold, and they are still the market leader with about 47% market share in streaming. Their monthly prices are still at least twice that of Disney Plus, with viewing hours in the US at least 3 times more than Disney Plus. But we do think or we do expect ARM to taper slightly. This mainly due to expansion into a lot of developing markets, which contribute lower ARM. So you think about it, all the developed regions in North America, your subscribers are only going to grow, a couple of percent every year. But when you think about subscriber growth, most of it is going to come from emerging markets in Latin America and Asia Pacific, which have significantly lower subscription prices. So it'll kind of skew the subscription price down a little bit. At the same time, they've also introduced a lower price subscription plan that is priced at about $7 US. So that's almost half of what the ARM is at this moment. So in terms of tailwinds, obviously they are going to still be going to benefit from tailwinds in a growing streaming industry. And we do expect 2022 revenue growth to be in the high single digits, so somewhere in the 6 to 10% year-on-year growth. It does look a little bit bad, but that is mainly because they do also expect about a 7% FX headwind due to a strengthening US dollar. So if you think about it in terms of constant currency growth, it's still in the mid-teens, so 15-16%, which is pretty healthy for a company on Netflix's size. In terms of their new ad-supported subscription tier, which they launched late last year, we do think that this would definitely help to benefit the bottom line margins. So moving forward, you're not going to be able to really see top line grow that much. Revenue is probably not going to grow as much as it was before, but how they're really going to generate returns for investors is by kind of growing their bottom line, and we think that obviously ad supported or rather generating ad revenue is definitely one way to do it, because ad revenue is significantly higher in terms of its margins, the margins that it contributes to the overall business. Currently, Netflix is trading at about 26 times forward PE, slightly above the NASDAQ average of 21 times, but well below its 10-year average of 100 times. And obviously, this is a bit skewed because they've only been profitable for several years, so the forward PE kind of skews this number a little bit. We do still see some sort of stagnation in terms of user growth in developed regions, as well as some revenue loss and revenue leakage from password sharing amongst its users, which is actually estimated to be quite a significant amount of Netflix's revenue. But overall, we are still quite bullish on Netflix. We have a buy rating with a target price of $346 US. So that's all for my companies. I'll hand my time over to Abrish to finish up with the rest.
Thank you, Jonathan, and good evening, everyone. So moving on to Microsoft, we have the title Continued Volume and Average Revenue per User Growth. Microsoft, it has two main growth drivers, and basically they are its cloud business Azure and productivity software Office 365. And the number of users and pricing is rising for both these segments. So moving on to our first thesis, there is continued momentum in cloud business Azure. Cloud computing, it basically means that you can store and access the particular information you can store and access that particular information over the internet, and you don't need to store it on your local computer. And also it is the main advantages are it's cost effective and safe and secured. So Azure, it has a market share of about nearly 22% right now, and it has doubled in last 3 to 4 years. So Amazon, it is the largest cloud computing public cloud provider, and it has a market share of 33%. However, we still believe that Azure, it will gain its market share mainly because of as the companies that digitize their operations amid the digital transformation trends. Also, there is the company claims that Azure, it has a pricing power over Amazon, and Azure, it has its integration capabilities with Office 365. The surge in Azure sales, it will also help Microsoft boost its profitability, mainly because it's a high margin cloud sales are high margin business. So we anticipate that its intelligent cloud revenue should grow by about 19% CAGR over the next 2 years. Moving to our second thesis, demand for its productivity software Office 365, it remains strong. So Microsoft, it has a market share of about 90% in the productivity software market, which includes its of softwares like Teams, Word, Excel, and obviously basically Office 365. So the key growth drivers for this segment are the economic reopening and the rising need to manage tasks and workflows. We expect productivity segment revenue to grow by 10% CAGR over next 2 years. And this is mainly would come from the rise in users as the offices reopen and they hire new employees. Then there would be more number of people who would be using Office 365. In terms of its negatives, there is a slowdown in the PC market, and it should hurt Windows revenue for Microsoft. The slowdown, it could be mainly attributable to slowdown. There could be a weak consumer demand for personal computers and also high inventory levels. Despite this, overall, we maintain a buy recommendation on Microsoft with a target price of $319. So moving on to other tech stocks. Next slide, please. We initiated coverage on Block earlier this week with a neutral recommendation. So Block, it operates as a financial services company, and it's a digital payments company. Its two main segments are Square and Cash App. Square, it basically provides point of sale solutions to merchants, whereas it's a Cash App segment. It's basically more like a banking application to consumers, wherein they can invest into stocks and buy and sell bitcoins. Also, it's a peer-to-peer payment transfer application. So in terms of its revenue contribution, Cash App, it contributes about 70% to its overall revenue, and the remaining 29% would come from Square. So moving to our first thesis, Square ecosystem, it simplifies commerce. So Square, it has a unique ability, like it helps its merchants to manage and grow their businesses across its in-store and online locations. So its product range, it ranges from point of sales solutions like hardware, software, like Square Stand, as well as chip readers. And in terms of its software, it provides services like to scheduling appointments, as well as inventory management, and also scheduling and wages management for its employees. So we anticipate a revenue growth of 24% for Square. And this is mainly driven by resurgence in in-person activities purchases by consumers in stores, and also a shift to cashless payments. So moving to our second thesis, Cash App, excluding Bitcoin revenue growth to remain strong. And so Cash App, it mainly targets the underbanked population, and it has about 50 million user base. So it was initially set up like a peer-to-peer payment app. However, it now has a robust platform. Like a consumer, it can invest into stocks, or it can buy or sell, trade bitcoins, and even it can transfer the bitcoins to other users. It also offers tax-related services. So this shift, we expect that its revenue growth, it should have a increase by 37% CAGR, and mainly due to the surge in its user base, as well as more adoption of its core services. Like it also provides a debit card, which is called as a cash card, and also like it provides a service like instant deposit, wherein it charges fees for that. So these should contribute to its growth. However, the growth in the Square and Cash App revenues, it should be pulled down mainly because of the fall in cryptocurrency prices and weak demand for Bitcoin. So we anticipate Bitcoin revenue fall of about 30%. So basically, for FY22, we anticipate its overall group revenue to be flat year over year. Also, Block, it is not consistently profitable, and we anticipate a net loss of 500 million in FY22. And this is mainly because it reinvests into its business for growth and innovation initiatives. So overall, we have a target price of $70 and a neutral recommendation on Block. So moving on to our next recommendation, Airbnb. We anticipate that travel demand should continue. So Airbnb, it is basically an online marketplace wherein which basically provides a unique homestays and unique experiences. So we anticipate total revenue growth of 25% year on year for the next 2 years. And this is mainly because of surge in booking volumes. We anticipate booking volumes to surpass its pre-pandemic levels in FY22, and they should report about 400 million nights and experiences booked in FY22. The surge, this is mainly because of a surge in urban and cross-border travel as the COVID-19 restrictions they eased. And also the long-term stays, which is like stays of more than 28 days, it remained resilient. This is mainly because of the flexible shift, the flexible shift to the remote hybrid work environment. Then moving on to our second thesis, businesses, Airbnb business, it is getting more profitable. This is we anticipate Airbnb to report a maiden net profit in FY22 of about 1.7 billion. And this is mainly because due to its surge in top line, boost in its revenue, as well as high operating leverage. And lastly, the travel spend, it is discretionary. So a reduction, high inflation and rising interest rate, it could have an impact on travelers' budget, and it could negatively impact Airbnb's revenues. So overall, we still have a buy recommendation on Airbnb with a target price of $128. We believe that the long-term tailwinds are still intact. Mainly, they could be a surge in demand for alternative accommodations. And also Airbnb, it has a unique supply of like more than 600 listings are over there. So that's all for Airbnb. I would now like to pass on to Max for PropertyGuru.
Thanks, Ambrish. So I'd like to touch briefly on PropertyGuru. So for PropertyGuru, we believe that it's going to continue to benefit from the strong property market in Singapore. Singapore has a strong supply pipeline that is extending for over the next couple of years, particularly in 2023, which is this year. And we think that the additions of more than 20,000 readily available units onto the market, as well as the rising rent and price indexes, are going to increase activity, market activity. So this we believe that this will hence open up more opportunities for PropertyGuru to capture. And then furthermore, with the reopening of China's border, we think that this is going to further add on to the demand of property in Southeast Asia. Chinese nationals were made up the largest proportion of foreign property buyers in the region. So, and they were actually heavily missed when the China restrictions started to roll out 3 years ago. So overall, we think PropertyGuru should be able to benefit from this positive trend in the market. However, we would like to note that the management of PropertyGuru during their last earnings call said that the cooling measures implemented by the local governments are expected to reduce the market activity, but they feel that the effects is going to be short-lived, and that they actually took it as a positive signal that the governments are actually confident in their respective property markets, and they are proactively taking steps to prevent it from overheating. So overall, we maintain our accumulate rating on PropertyGuru with a target price of $5.30. Yeah, and then so that's all for the tech recommendation for us. And here's a quick summary of all the stock coverage that from our team. And some of these are not presented today, but you can take a look at this list in our website at Stocks PNB. So right now, I'll hand over my time to Zain to talk about the technical analysis section. Thank you.
Thanks, Max. So now I'll go through the technical analysis section where I'll be covering on the outlook of NASDAQ as well as the S&P 500. So for the NASDAQ, just a recap of what happened in fourth quarter last year. We actually kept in this bear flag over here in the chart shown. So we just sort of sideways in this bear flag. So the low we hit was about 10,000, where the high was about 11,500 level. So for the outlook for this quarter wise, you can see that we are still kept in the downtrend channel. And then for the strong resistance zone, we will be around 11,200 to about 11,700 area. So when looking at the Fibonacci levels, the retracement levels measuring from the COVID bottom to the to the peak in 2021, right? So that's about, the resistance is about at the 50% mark. So if we are to take a more conservative stance this quarter and follow the trend that we are still in a downtrend, we could potentially actually make a lower low this time if the 10,000 psychological key level is being breached. So we could actually hit the support zone between 8,700 to about 9,700 points. So 9,700 points was the level of, was the all-time high level of the NASDAQ pre-COVID, while the 8,700 level was a key level when the NASDAQ rebounded post-COVID level. So if I take a more conservative stance, we could actually hit this zone if the key 10,000 level is being breached for NASDAQ. Next slide. So for the S&P 500, it's also forming a bearish flag in this downtrend. So the recap of what happened last quarter was that we hit a low of about 3,005, and subsequently we had staged a short rebound in the last quarter to hit about 4,001, where we met the resistance of the key downtrend resistance line. So this, I think it will be important to pay attention to this key resistance line because it has resisted the index for multiple times ever since we peaked for S&P 500. So we are likely to see continued resistance at this line, which is about 4,000 to about 4,200 in the resistance zone. If we do break down the bear flag that is currently forming, we could actually do a retest of the lows we had last year in October. That was about 3,500, which also matched with a 50% Fibonacci retracement level when we take the COVID lows to the all-time highs for the S&P 500. If you do get lower than that, the next level to look at will be around 3,200, which was a support level when the index kind of range traded in September to October in 2021, and that's also a 61.8% Fibonacci retracement level for S&P 500. So this is a more conservative target that we could have for first quarter 2023 for S&P for maybe hit 3,002 to 3,500 points. Okay, so that's all from me for the technical analysis section. I'll now pass on my time back to Jonathan to give a summary of today's session.
Thanks, Zane. Yeah, just so to conclude, after all this being said, we do still expect inflation levels to remain relatively high. I think it's still going to be a little bit sticky, mainly because of a very tight labor market, as well as wage inflation. We obviously do still see a lot of positive signs for inflation to start to continue coming down. But we still do expect it to be a little bit higher than a little bit elevated compared to what it was over the last several years. We do also think that defensive should still outperform in the first quarter of this year, just given continued momentum throughout the whole of last year, as well as there's still quite a risk of sentiment in the markets, obviously due to high interest rates and high inflation. And the last point, we do think that you should really look to earnings growth for opportunities, especially with valuations being quite low for a lot of companies that we mentioned earlier. We think that what's really going to drive stock prices up is going to be earnings growth. It's not really going to be anything else, because the Fed's not really going to be pumping up the market like it's been doing for the last 10 years anymore. And so look for solid companies that you expect earnings to grow, so margins to expand a little bit with healthy free cash flows. So I think that's all for us for today. Please, if you want to know a little bit more, you want to interact with us, please feel free to download the Fluence World 3 app and join one of the community pages, or rather one of the community groups there. We do post quite regularly, so if you do want to just have a chat with us or kind of share some ideas, please feel free to reach out to us over there. I think we can head over to Q&A right now. We'll just kind of free roll it, take it as we go. I'll take a few questions and then I'll hand it off to my colleagues for the rest. So the first question here, Meta's target price is 113, the last price was 132. Why recommend a buy? Yeah, so if you look at, I'll bring you back to the yeah. So we actually have an accumulate on Meta. This target price was derived after they announced their third quarter earnings. So actually before they made their announcement about cutting jobs, I believe the target price back then was about 100, 105. So like I mentioned earlier, we are kind of positive on Meta long term. In the near term, we still do think that there are some challenges. It's just that when they announced, they're going to be cutting 11,000 jobs. I believe the stock price went up by 15%, 12% that day, and it's been kind of just gathering momentum ever since then. So we will obviously take a look at these target prices at least once every quarter or after they put out their earnings calls to kind of recalibrate a little bit, especially because of fourth quarter coming out, and I have to reforecast for an additional year, and that most likely your target price just kind of changes as you go along. I hope that answers your question. Second one here is, what is your view on Tesla? So unfortunately, we don't really cover Tesla, but I had a brief look at it, and obviously their deliveries number was a little bit below expectations. But when you look at the stock, it's trading at like 100 times PE. Right now, it's still trading at 40 times PE, so it's still twice the NASDAQ's average. So essentially, it's still expected to grow twice that of the NASDAQ at least. I think that it has come down to actually fairly reasonable valuations, given the fact that their net income is expected to at least double for this year, I believe, somewhere there around those lines. We do think that obviously a lot of the traditional car makers are catching up in the EV space, so there's a little bit more competition, especially from within China, which is very big on EVs. But we still do think that demand is strong for a lot of the Tesla vehicles, especially because I guess they're viewed a little bit more as on the premium side. Just think that like most other companies, valuations have just come down a little bit, and as investors get a little bit more cautious. There's another question here. For year 2023, what is the best possible performance sector? What is recommended stock then? So for this year ahead, number one, I still think that energy will outperform. I think even though the oil prices have come down, you still have natural gas prices that are quite are still going up. They're still in high demand. There's a lot of pressures, especially from the opening of China. China's been in a very a different situation from the rest of the world over the last couple of years. They've been kind of locked up. They've been in a very restrictive. They've got their very restrictive policies. Now the government's kind of trying to stimulate the economy. So we do think that this obviously would place a little bit more demand on your energy stocks, right? Because if you're trying to boost the economy in terms of construction or anything else, then you would have these kind of tailwinds for the energy sector. We do also think that defensive sectors will still perform well relative to your other stocks, at least for the first half of this year. And my view is that maybe towards the end of 2023, you see a little bit more outperformance from your discretionaries and your high growth tech sector. I think that's all for me for now. I'll hand it over to the rest of my colleagues. I think we'll just do 3 each, and then we'll just keep rotating. So maybe Amrish, you can take this question question on UBS?
Yeah, sure. So there's one question regarding Microsoft. UBS downgraded Microsoft and projected slow Azure and Office 365 sales, but you are recommending a buy. Is UBS wrong? I'm really not sure. Maybe time would prove that. So overall, we do expect could be a moderation in Azure growth, but I mean, we still expect that its sales should grow by about 40% year on year in FY23. And also additionally, it is more, its earnings are more based on corporate earnings, and it's not linked to consumer, which is one time. Most of its revenue comes from corporates, which I mean, corporate, they would still need to buy Office 365 and Azure in order to be competitive. So yeah, and there was another question like, what is Microsoft PE now and their 10-year average PE? Microsoft, it is currently trading at a PE of about 24, and its 10-year average PE would be around 20. So, there was one more question with respect to PayPal. We cover PayPal. I mean, I'm not able to locate that question. Yeah, any comments on CrowdStrike, PayPal, and Uber? So we cover PayPal, and we have a target price of $110. The main tailwinds for PayPal could be like it's a two-sided network. It focuses on consumer as well as the retailers. Like they have about 400 million users, consumers, as well as 35 million of merchants, which have signed up to PayPal service. So with this two-sided network, it is expected to grow. And also there is a shift to digital payments. And PayPal, it has also entered into agreements with Amazon, and as an e-commerce, PayPal has been added as a payment service on Amazon, and also it has partnered with Apple's tap to pay technology, wherein Apple payments, whereas merchants, they could use their iPhones to accept payments. So overall, we have a target price of $110 on PayPal. So that's all for me right now, and I would now like to hand it over to the rest of my team.
Yeah, thanks, Ambrish. So there are some questions. I'll take some of the questions regarding semicon. Yeah, although we don't cover any semicon companies right now, I'll try my best to answer them. So actually, a lot of the questions are similar to each other. It's mainly asking for our views on the semicon industry. So for the semicon, is kind of for each company is different. It depends on which area which industry the semicon company is focusing on. So currently the microchip that are in high demand particularly for data centers, as well as automotive and industrial machines. But whereas those for the consumer tech, such as PCs, is facing a decline. So if we take a look at this company, for example, like Micron, their main focus is on memory, which is mostly used in consumer tech, which is smartphone and PCs. So so the demand for these PCs is slowing down, and coupled with the fact that they are having high channel inventory levels right now, meaning that the customers have a lot of stocks of this chip that is produced by these companies. So naturally, the customers will not order any additional chips until the inventory has run out. And so, however, if it's companies like NVIDIA, for example, NVIDIA used to be big on gaming, which is they are still now, but revenues for the gaming segment for the past few quarters have declined because it's the same thing as well. They have a lot of they are facing high levels of channel inventory because firstly, people are not buying PCs that much, and then secondly, the cryptocurrency market crash and miners are just selling their GPUs in the secondary market, and hence decrease the demand directly from NVIDIA. So so with that said, right, even though the demand for data centers is increasing, it is offset by the decline in demand in the consumer tech segment. So I think I think it's mainly because you have to see which for each company which segment contributes more towards their revenue. So I think with that in mind, so with that said, I think it's a balancing act. Like if you increase for data centers, you are facing decrease from consumer tech. So I guess that's why there's not really much movement, and that's what we view for semiconductor as of now. Hope that answers your question.
Zane, there's a question for you.
Okay, I'll just take the question on DraftKings. So there's a question: is my TA report for DraftKings dated 5th December last year still valid? Actually, it has hit our stop loss already. So the trade was invalidated quite long ago. Yeah, the stop loss was at $13.30. So you have been validated on 15 December. It has hit a low of back $10.90 before currently rebounding a little. Yeah. So I think that's all for me.
Thanks, Ian. Okay, so I guess I'll take some more questions. There's one here, your view on Alibaba. Unfortunately, we don't really cover the Chinese ADRs in the US. But if you missed, usually this is covered during the Hong Kong session. So if you missed that, I think you can go to YouTube to check it out. I'm sure there would have been people posting on that. Likewise, what do you think will be the impact of China opening up? We don't really cover China over here. All I can say is when I look at K-Web, which is the China Internet ETF, it's basically gone up 100% last quarter, which is quite tremendous. Other than that, I'm not sure I can say much more. There's a question here, your view on Disney versus Netflix in the next 1 or 2 years. Okay, so Disney versus Netflix has been a debate that's been going on for a long time. We are firmly on the side of Netflix, mainly because of how their ARM is higher, their margins are better. They're able to kind of generate a little bit more from its customers. At the same time, when you look at the viewing stats, when you look at the top 10 weekly viewing charts, at least 6 or 7 on that list will be coming from Netflix. You don't usually, maybe 1 or 2 coming from Disney. So in terms of the quality content, Netflix is still the winner there. In terms of monetizing their users, Netflix is still the winner. And Disney's numbers are a little bit inflated because it takes into account a lot of their acquisitions of, or rather, a lot of their other companies like Hotstar, and so it kind of boosts their numbers a little bit. But when you look at the ARM, which is the prices, the monthly prices, it's about half of Netflix. We do think that they both benefit from the streaming industry moving forward. But if you were to pick a winner, I would definitely, I guess I'll still pick Netflix as the winner if there were just two stocks in the universe and you had to choose one. Thanks. I hope that answers your question. There's another question here. What would you recommend tonight? CPI data, beat, exceed, or miss? So I think, honestly, by the time the CPI data comes out, you're probably a bit late, judging from the last few trading days where all the algo traders come in. But I would say that it obviously, if it doesn't meet or exceed, you would think that the markets will start to run because I believe the previous CPI reading was 7.1, so that's quite a significant drop. It's a 0.6% drop. But obviously, if it misses, then the likelihood is that expectations for the Fed to continue being fairly hawkish would persist, and you'd see a fairly big sell-off there. I think previously bad news used to be good news because the Fed would just prop up the market. But right now, I think good news is good news. Bad news is really bad news, and average news is not too bad. I hope that answers your question. There's another question here. Target price for C is 110. This is almost double from the last done price. Can you share a little bit more about why you're so bullish about C? Okay, so for C, one of the reasons why we're bullish is because they've taken a massive beating over the last year or so, and so valuations have come down for C a little bit, quite a bit. Secondly, they are even though their gaming arm, which is Garena, which has always been their cash cow, even though that is tapering a little bit, we do see the emergence of Shopee coming out. Shopee has they're actually really close to being beta positive if you take out some of the HQ costs. So especially in a lot of their mature markets. So we do think that when you look at their GMV and their performance of the last couple of quarters, I believe they are close to, or they slightly exceeded that of Alibaba's performance ex China. So Alibaba's international performance. So if you think about it from that perspective, we do think that there's a lot of opportunity for C, for Shopee in particular. At the same time, they're not really like an Amazon. They're very niche in terms of their target market. So they target a lot of your developing countries, and the products they offer are also a lot more on the more affordable consumer staples, and that's kind of where they're focused on. So high volume, low margin business. But that being said, that their target, or rather their kind of expected the population that they expect to serve is like in the billions, several billions. In terms of when you factor in all these emerging markets. So that's mainly one of the reasons why we are bullish. We think that once they're on track to being profitable, and once they do cross this hurdle, we think that they will exponentially increase their margins, and hopefully the stock price will go along with it. There's a question here also. What's your view on Palantir? Unfortunately, we don't really cover Palantir, so I can't really give too much insight on that. Sorry about that. There's another question here. Is tech likely to recover in 2023? So our consensus is that for the first half of this year, we do think that we'll see a lot of sideways movement, especially with a lot of recalibration in terms of margins, as they've begun laying a lot of people and becoming a little bit more prudent in their spending. But in terms of the growth story, obviously the first thing that needs to happen is interest rates kind of have to come down a little bit. But once they do start coming down, and we see a little bit more growth in terms of numbers for tech companies, then you most likely you'll see this explosive move to the upside, because tech has been beaten pretty badly over the last year. But like I mentioned earlier, when you look at their earnings per share for the QQQ, or rather for the NASDAQ, it hasn't really declined that significantly. It's more of people are just not willing to pay for it. Yeah. So I think once you get the previous slide where I showed the earnings yield, once you get that to kind of widen them a little bit, then I think investors will be a little bit more, I guess, risk off and or rather risk on, and kind of start piling into tech stocks again. And we do think that this is a second half play for this year. once the numbers, once CPI, once your inflation data comes down a little bit, and once interest rates start to taper off. Yeah. Let me see if there are any questions here. Will the fundamental of Meta be affected negatively by their investments in the metaverse? So I guess the short answer is yes. But at the same time, a lot of their spending is, or rather most of their spending is actually not going into the metaverse, it's actually going into changing, into platform changes. So a lot of their infrastructure spending is going into changing their platform from a feed and stories into reels, and that's quite a significant change for them. The company has also mentioned that they are looking into metaverse spending a little bit differently. You know, they're not going to just be splashing the cash. They're going to be a little bit more cutthroat when it comes to who they hire and how much they pay, and also a lot of the IT infrastructure that is required for the metaverse. And so, yeah, so you know, we do think that obviously the metaverse is a long-term kind of plan for Mark Zuckerberg. You know, he mentioned that it's like a not even a 5 to 10 years, a 10 to 15-year plan. So hopefully they're able to get their margins back on track, and that should provide some sort of price stability for the company. Let me see if there yeah, there's one. Do you have any thoughts about metaverse ETF like METV? Sorry, but we don't really have. Let me take a quick look at it. Quite sure it has been down quite a lot. Yeah. Let's see some of the holdings in METV. So you've got your I guess there are your big companies like Apple, Nvidia, Microsoft. But like all your tech growth, they're gonna pretty much react the same way. Risk off, they're gonna get crushed, and once risk on, once there's a risk on sentiment in the market, it's probably gonna run pretty hard. Yeah. This question, yeah, I missed the early part of the seminar. What are your recommendations of Apple and Google? Over here, Apple is a buy at 190. Google is a buy as well at 124. Yeah, so I think I have time for one more. Really for all the chips, they were answered by Max already. So, okay, it's a good question here. To have so many buying all definitely isn't a solution since it's like running an ETF. What do you suggest to a person who has trouble choosing among the buys? So what I would suggest is you kind of look at the underlying industry that drives them, right? And you see, whether this industry has a moat surrounding it, or whether this industry is gonna outperform another industry, for example. And then you have to look at a company's operating leverage. How fast can it scale? How much free cash flow it generates? Whether their margins have been contracting or expanding. So I think it really boils down to the kind of the quality companies that you look at. And so far, the quality companies right now, you still got your Apple, Alphabet, and so on. We still think that they're going to be good buys, not just for the near term, but for the long term as well. Yeah, I hope that helps and answers your question. So unfortunately, it's come to about 9 o'clock. It's come to the end of presentation. I just want to thank everyone for spending your evening with us. It's a little bit of a lengthy session, and we appreciate you listening to our presentation and to our Q&A.